Our population's growing. Why? Because of the energy and daring of entrepreneurs that are growing and dominating in the industries of the future. To those with that California derangement syndrome, I'll repeat, it's time to update your talking points.
But the people with the most skin in the game are heading for the exit. New reporting shows that at least half a dozen billionaires have already left the Golden State. Up to 20 more could be packing their bags as a proposed 5% wealth tax remains on the table. The latest, Google co-founder Larry Page is headed to Miami, Florida. But he's not alone. Peter Thiel, Larry Ellison on the move to red states like Texas and...
6 billionaires controlling more than $800 billion in combined wealth reportedly shifted their primary residences and business entities out of California within a single month, creating what analysts described as a major fiscal jolt for the state. When high-profile figures such as Larry Page, Sergey Brin, and Peter Thiel adjust where their fortunes and companies are officially based, it can quickly spotlight how dependent a revenue system may be on a very small number of top earners.
It's the California gold rush in reverse. Google co-founders Larry Page and Sergey Brin, just the latest tech billionaires eyeing a move out of the Golden State.
Public data shows that roughly 100 to 75,000 high-income households contribute a significant share of California's income tax revenue, helping fund public programs and infrastructure. This concentration has raised ongoing questions among economists about sustainability, especially if even a small portion of that group relocates. As the world's fourth largest economy by some measures,
I think a lot of other people will leave. It's probably half the total wealth that the budget estimated would be available to be taxed will be gone.
California's financial structure attracts constant scrutiny when major wealth holders make noticeable moves. According to public filings released in December 2025, several business entities connected to Larry Page, including a family office and an aviation-focused venture, updated their official addresses from California to Florida shortly before a proposed wealth tax residency cutoff date.
5% tax rate out of California. You should be very, very concerned.
Additional entities tied to philanthropic and research initiatives also reflected address changes based on publicly available records. Tax professionals cited in financial media suggested these adjustments may have been strategic positioning ahead of a proposed one-time 5% wealth tax scheduled to apply to qualifying residents as of January 1st, 2026. Commentators emphasize that such relocations are typically guided by legal and financial planning teams working within existing laws.
Facebook founder Mark Zuckerberg has bought a $150 million home in Florida.
Peter Thiel, who has previously expressed concerns about California's tax environment in interviews, expanded his presence in Florida, while reports from industry observers indicated that entities linked to Sergey Brin were reorganized in Nevada, a state without personal income tax. Each move appeared to reflect calculated financial planning as businesses had evaluated evolving state tax policies. Elon Musk's earlier relocation to Texas had already shown how dramatic the financial impact of a residency shift could be. According to estimates cited by financial analysts, moving ahead of major stock transactions may have reduced his California tax exposure by more than $1 billion.
The problem, just talking about it, is sending billionaires running to red states across the country, adding on to the exodus the state has seen since the COVID pandemic, with over 1.5 million people and counting departing the Golden State for greener pastures.
By December 2025, new filings from other high net worth individuals signaled that these types of moves were not symbolic gestures. They were strategic financial decisions with serious implications. For California, the bigger issue is structural. The state's budget relies heavily on a very small percentage of top earners. In most years, dividing the top 1% contribute between 38% and 50% of all personal income tax revenues. That means a population smaller than many mid-sized cities is responsible for nearly half of the funding that supports statewide operations. Expanding the lens further, the top 5% of earners account for roughly 70% of total personal income tax collections. About 175,000 high-earning households generate more than $100 billion annually for the state treasury, a figure that exceeds the combined contributions of the remaining majority of filers. This level of concentration creates a system that can feel stable during economic booms but highly sensitive during shifts. At the very top tier, the average income for the top 0.1% approaches $13 million per year, which is around 250 times higher than the state's median income. When technology markets rise or major liquidity events occur, revenue surges quickly. But if top earners change residency, restructure compensation, or delay income recognition, the fiscal effect can be immediate and significant. This dynamic leaves California's financial outlook closely tied to the decisions of a small and highly mobile group. Public services such as education, healthcare programs, and infrastructure depend on consistent revenue from these households. Recent IRS migration data has shown an ongoing pattern of high-income taxpayers relocating, adding another layer of uncertainty to long-term budget planning. In 2022 alone, more than 24,000 households earning above $200,000 reportedly left California, a 7.2% increase compared to the previous year. According to publicly available tax migration data, these households represented a combined $16.1 billion in adjusted gross income. That amount exceeds the annual operating budgets of many mid-sized California cities, showing just how significant the shift has been. Looking at a broader timeline between 2020 and 2022, the cumulative net adjusted gross income leaving the state surpassed $100 billion. Economists describe this not as a one-time fluctuation, but as part of a continuing pattern. Since 2020, California has experienced a net population outflow ranging between roughly 268,000 and 300,000 residents per year based on IRS and census estimates. Higher income earners appear to be disproportionately represented within those numbers. Many of the departing households relocated to states such as Texas, Nevada, Florida, Arizona, and Tennessee. Notably, several of these states do not impose a personal income tax, which financial planners often cite as a major factor in relocation decisions. For individuals with substantial annual earnings, even small percentage differences can translate into very large financial outcomes. During this period, Texas reportedly experienced a net income gain of approximately $14 billion from incoming residents, while Nevada and Florida each recorded gains in the high single-digit billions. Analysts note that as more high-income households reposition themselves in lower tax states, California's revenue structure becomes increasingly sensitive to mobility trends. The pattern has drawn attention from policy experts who argue that the state's fiscal health is closely linked to where top earners choose to establish residency. Corporate relocation announcements, including Oracle's December 2020 headquarters shift, were viewed by some observers as early signals of a broader transformation unfolding in real time. A company SEC filing confirmed that its headquarters would move from Redwood City to Austin, Texas. Soon after, Tesla announced in 2021 that it would relocate its corporate headquarters from Palo Alto to Austin, while continuing to operate its Fremont factory and maintain a significant Bay Area workforce. Hewlett-Packard Enterprise shifted its global headquarters from San Jose to Houston, and Charles Schwab transferred its principal office from San Francisco to Westlake, Texas. Although these companies still maintain large operations in California, the formal relocation of their headquarters carried symbolic and financial weight. Investors, employees, and policymakers closely watch these announcements, viewing them as indicators of shifting business priorities. Over time, the cumulative impact means that thousands of high-paying executive and administrative roles, along with future investment flows, are increasingly tied to states with lower tax structures. Budget data highlights how quickly fiscal conditions can change. In 2022, California reported a $97.5 billion surplus, largely fueled by strong capital gains revenues and a thriving technology sector. By the 2024 to 2025 fiscal outlook, projections shifted dramatically toward a deficit estimated between $55 billion and $73 billion. The The Legislative Analyst's Office has also projected ongoing structural gaps ranging from $12 billion to $20 billion annually through 2027. Over a 4-year span, total revenues came in approximately $165 billion below earlier expectations. At the same time, California's largest public pension system, CalPERS, reports an unfunded liability of about $166 billion, which equates to roughly $6,000 per resident. State spending on homelessness programs reached $24 billion between 2019 and 2024, yet official counts show the population experiencing homelessness increased by approximately 30,000 individuals. Analysts note that while corporate headquarters relocations are not the sole driver of fiscal pressure, each move and each high-income departure adds another layer of financial strain to an already complex budget landscape. As the tax base narrows, funding essential services becomes more complicated, and the margin for error tightens with each new budget cycle. In Stockton, a 4th grade teacher unlocks her classroom and finds a notice outlining potential staffing adjustments and program reductions. The district has begun scaling back certain enrichment and arts offerings due to financial pressure. She is told her role remains secure for now, but uncertainty lingers in staff meetings and daily lesson planning. Her district, which previously benefited from strong state revenue growth, is now managing a multi-million-dollar shortfall. Administrators explain that funding connected to state income tax collections has declined, forcing difficult decisions. Hiring pauses are in place, and maintenance projects for older school buildings have been delayed. What once felt stable now feels fragile, with every expenditure reviewed more closely than ever. Across town, a small bakery owner reviews monthly sales reports and notices a gradual dip. Some longtime customers, engineers and designers who once worked in nearby offices, have relocated or shifted to remote roles based outside California. Foot traffic is lighter than it used to be. At the same time, suppliers have increased prices, squeezing profit margins. His accountant cautions that local governments may consider adjusting fees or taxes if state support continues to soften. The figures presented in budget documents are no longer abstract. They translate into real-life trade-offs. Fewer classroom resources, postponed infrastructure repairs, and tighter operating margins for neighborhood businesses. During a recent public budget briefing, the state's finance officials outlined projections showing a deficit estimated between $55 billion and $73 billion. They also reiterated that a significant portion of personal income tax revenue continues to come from a relatively small share of households. For communities on the ground, these shifts create an atmosphere of caution. Planning for the future now depends heavily on how stable or unstable that concentrated revenue stream remains. During a fiscal policy briefing, the budget director highlights economic simulations suggesting that even a modest 1% surcharge on incomes above $5 million could generate up to $1 billion annually. However, policy analysts caution that higher rates may also increase the likelihood of relocation among top earners, especially in a highly mobile economy. An academic economist then outlines the financial comparison facing ultra-high net worth individuals. For an investor with $10 billion in assets, the difference between California's top income tax rate of 13.3% and a state with no personal income tax, such as Texas or Florida, can translate into roughly $93 million in annual tax savings. Over a decade, that gap compounds significantly. When discounted over time, the projected value of relocating before a major liquidity event could approach $1 billion, depending on the structure of income and timing. The economist adds that refining residency definitions and strengthening income sourcing rules might recapture an estimated $300 million to $500 million per year, but only if enforcement resources and oversight keep pace with increasingly complex financial planning strategies. A technology industry association leader shifts the discussion toward competitiveness. According to member surveys, operating in the Bay Area can carry a 30% to 40% cost premium compared to cities like Austin. In response, proposals under discussion include expanding innovation tax credits aimed at research and development, along with targeted incentive funds designed to encourage companies to retain headquarters and laboratory operations within the state. She argues that these types of incentives could influence decisions among an estimated 15 to 20 prominent technology-focused families currently evaluating long-term residency and investment strategies. The broader consensus at the roundtable is that no single policy adjustment will fully resolve the imbalance. Instead, a combination of carefully calibrated tax measures, consistent enforcement, and strategic business incentives may offer a more stable path forward. At present, California's revenue structure remains closely tied to the decisions of a relatively small group of high earners. As mobility increases, each relocation carries broader implications for budget planning and economic positioning. The choices made in the coming years could shape not only California's fiscal outlook, but also its role in the national economic landscape. If you found this breakdown helpful, make sure to follow the channel, share this video, and stay tuned. There's a lot more coming, and it only gets more interesting from here.